Hello and welcome back to the Mortgage Corner. Today we'll be talking about the importance of getting a pre-approval and what a lender looks at in order to issue that pre-approval. But before we do, hit the like and subscribe button. It really does help me out. Hit that bell notification so you always stay up to date on all my future content, and let's get started. So I know in the grand scheme of things, as far as buying a new home goes, the lending aspect and the getting your home loan is probably not exactly high up on your list of the fun and exciting portions of the process. But it is one of the most important aspects to get in order before you even start looking at homes. So before you even start scrolling on Zillow, on Redfin, and talking to a bunch of realtors, I urge you to get your pre-approval set up so that you know exactly what you can afford, and that will just help you narrow down your search and know exactly what kind of home you're looking at, and help you know if you're even financially ready to buy a home. If you don't have a lender already, and you do have a realtor, and you don't even know where to look for a lender, be sure to talk to your realtor about it, because oftentimes they have lender partners they work with often, and that way it's someone that they trust and they know their work methods, and the lender knows the realtor that way, and it's just a smoother transaction for everybody, and you have a team right out of the gate who's there to help you and work together for you. So the first question is what do lenders even look at in order to give me my pre-approval? Well, it really boils down to three things: your income, assets, and credit score. Income obviously is pretty straightforward and very important. It's how much money you're making. And usually to look at that and verify it, the lender will want to look at some pay stubs, they'll want to look at your W-2s, and that'll just kind of verify the number you make. And sometimes they find ways to really leverage it, or sometimes they'll have to look at that if you make a lot of like overtime or you get bonuses, then they'll use all that stuff to average it out for you and find the exact number that they can use for your monthly income and move forward in that sense. Because your income is really important, because you're only really allowed to use a certain amount of that to go towards your mortgage. And kind of a budgeting tip would be to kind of plan on using no more than like 35% of your income towards that monthly mortgage payment. And that usually puts you in a safe spot. And if you go into it planning on that, then you won't be too surprised on what the lender says, and maybe they'll even be able to get you a little bit more than that. It really depends on what loan program you're using. They all have different requirements as far as what your debt to income is what they call it, on what those numbers can be. They don't differ a whole lot, but a little bit. So it does depend on your loan program. As far as your credit score goes, it's kind of a hot topic, right? Again, it depends a little bit on what loan program you're using. FHA and VA, they're more around the 580 mark for a minimum credit score, where a conventional loan program is 620, so it's a little bit higher. But obviously the higher your credit score, the better. It helps with your rate. It helps with kind of almost everything involved. Just makes your file look even that much stronger. If your credit's not in a spot where you'd like it to be, or you don't even have a clue on what your credit is, that's okay. But oftentimes your lender can help you build that credit up, or they know someone who can help you. And there's a lot of different ways to keep track of your credit. It's a very important aspect, even beyond mortgages. It's always good to know what your credit score is at and how to build it and make it even a stronger score for you. And then with your assets, the lender will usually want to see a couple months worth of bank statements for any bank accounts you have and that you plan on using for the transaction. And that way they can just verify the funds are there for what you're saying you have. So like if you walk in, you're like, hey, I'm going to pay $30,000 for my down payment. They're going to look at that bank statement just to confirm, yes, you do have $30,000. And then it's also just a way to keep fraud out of the equation. Another way just to make sure that funds are where they're supposed to be, that they're all coming from proper sources. It's just to kind of cover the lender in that sense and make sure you don't get in trouble down the road as well. Another little aspect that goes with pre-approval is your liabilities also, which usually you can see all that in like your credit report and such. And then the lender will look at that stuff, and if you have car payments and other loans, student loans, that kind of stuff, then they can look at that and maybe be like, hey, you're paying this much towards liabilities every month, but if you paid $25,000 instead of $30,000 down, then we can take that extra $5,000, put it towards one of these liabilities, pay it off, pay it down, whatever, so that you're paying less every month, and that way you'd be able to get approved for more per month towards the home. So it's just one of those things the lender can look at and maneuver the pieces around to really maximize your buying power. Which that does kind of lead us into another thing, which is kind of the cash, right? You have the down payment you're doing, which depending on your loan program can vary. For VA, it can be as low as 0%. FHA is 3.5%. Conventional is 5% unless you're a first-time home buyer. Then you can go as low as 3%. And then also something to always remember and consider is that you have your closing costs tacked onto the end. Usually that's just like lender fees and tax stuff, all that sort of thing just roped in at the end. And usually just plan on that being like 2 to 3% of the purchase price, just as a rough number, so at least you can kind of plan on having that extra money coming in. And there are ways to help with that. You can always get help from the seller concessions and stuff like that if your money's a little tight in that area. And of course, your lender can always look into down payment assistance if you need that. But another thing to always remember is that the lender always has to be able to show where the money came from and where it's at. So if you get gift funds from your mom or a relative, they'll want to not only look at your bank statement to see that the gift money is in there, but they'll want to look at the bank statement for who gave you the money. So that they can say, okay, the money came from here, it's going over here to this account, we know where it is, we know where it came from, everything's good and hunky-dory, there's no fraud here. And then they always have to know where the funds are, where they came from. So always go into it knowing that any cash involved, all that stuff, you have to be able to prove where it is and where it's coming from. So when you go ask someone for that gift money, be sure to let them know too that they'll have to provide that, because some people, maybe they won't feel comfortable with that, or they'll want to talk to your lender just to see what's going on. So just make sure that you're upfront and honest with that so that people know and can expect to provide that kind of paperwork. You just always have to be able to show the paper trail. Well, those are the main aspects of how to get the pre-approval. You got your income, your credit score, your assets. Liabilities can play a part in there as well, just if the lender's trying to leverage it around. So if all that stuff looks okay, the lender will go through and he'll come up with a number. And then he'll let you know, hey, you can afford a loan for $500,000 or whatever, or you can afford a monthly payment for this amount, which would buy you this big of a house, that kind of thing. And then he gives you that letter, he gives you that information, so you can go, if you already have a realtor, he'll let the realtor know as well. And then that way you know exactly what you're shopping for. You can go around, you can look exactly in that price range from 500 or lower, or whatever it is. And that way you come in, you're prepared. When you put your offer in, you have that pre-approval letter so the seller knows, hey, the lender already is saying that based on what he's seen so far, they are approved and that the financing should be good. And if you have the time, and if the lender's quick enough to do it, he can submit for a underwritten pre-approval. And then that way your pre-approval has already been looked at by an underwriter. They've already verified a lot of the account information and the work history, all that stuff. So then you're just one step closer for after your offer is accepted. Then you've already gone through the first stages of underwriting, which is kind of a whole other topic to talk about later. But it also just makes your offer look that much stronger, because then they know there's been even more eyes on your file, more people saying, yeah, you're good to go, you're approved for this amount. So ask your lender, if you're like, hey, I'm just starting now, like I'm taking my time looking at houses, let's submit for an underwritten pre-approval. It just makes everything look stronger. So if you are in a bidding war too, then they'll most likely go with the underwritten pre-approval over the non-underwritten pre-approval. Well, that is it for today's video. I hope you find this information helpful and beneficial to your situation. If you have any questions whatsoever, feel free to leave a comment down in the section below. If you have any ideas for any future videos, feel free to let me know. Hit the like and subscribe button, and I'll see you guys in the next one.